Mark Hulbert is with us in bucolic Chapel Hill. Morning, Mark. How are you?
Okay, how are you?
So your column today on Market Watch is about Facebook and about valuations. And your point really is that Facebook has a lot of growing to do to justify their valuation, right?
Yeah, that's a fair summary. It turns out that most people don't even try to address this question because it would appear you have all these assumptions that you have to make before you can calculate what the growth rate is necessary to justify the stock price. But it turns out that actually, as I explained in the column, the mathematics is not all that difficult. And I make a couple simple assumptions about how much the stock's going to grow and so forth over the next 5 years. It turns out that to justify the price at which the stock is currently trading in the secondary market, Facebook earnings are going to have to grow at an annualized, this is not total, annualized rate of over 40% a year for the next 5 years. There are hardly any companies in history have done it. Now, Google is one of them. A lot of people are comparing Facebook to Google, but the question is how many times can lightning strike twice?
Right.
Okay, and Mark, and so that's an essential question. Is Facebook more like Google or more like Groupon, Xenia? I mean, am I going to regret buying on the second day, the day after the IPO?
Well, the question is just a matter of odds. If most companies that have come to market with valuations like looks like Facebook's going to come to market at have not justified their price, then the odds are that that's going to be a risky bet. Does that mean you will regret it? Well, there's always a chance that you'll regret it. I said the same thing when Google came to market back 7-8 years ago, and of course I lived to regret it, and all the commenters on the website have called me every name in the book for having missed that one. But it turns out that there are a number of other IPOs where the same mathematics led to the same conclusion, and a lot of people should be thanking me. Of course they're not, but nonetheless, the same mathematics leads to the same conclusion.
Yeah, it seems to me another good example to compare them to is Apple, which is just having spectacular growth rates. I'm not trying to harp on Apple today, just saying that, they have spectacular growth rates. But for Apple, they have a defensible position. Their products are just much better than anyone else's products. For Facebook, it seems to me that Facebook, somebody could come in and eat their lunch very easily, grab the cool kids, they're out of there. That, you're talking about 5 years' time, Mark. Facebook could be gone, could be done in 5 years' time.
Well, that's right. What you're identifying exactly correctly is how much risk there is involved. With Apple, regardless of what else you think about their stock's valuation, it turns out that it is, an established business, a very established business with a very well-recognized product line and a wide moat, to use a term that a lot of fundamental analysts use, that prevents other people from at least immediately getting into that space. Facebook has a much greater riskiness in trying to execute on its business model, which only makes it that much more of a stretch when you try to bet on whether they're going to be able to produce annualized earnings growth of 40-some%.
Okay, Mark, and I'm gonna put you on the spot real quick. What's the appropriate price for Facebook?
Oh,
okay. I put you on the spot. I know I did.
But I mean, if you look at growth stocks historically, very, very few growth stocks have produced earnings growth that are above the median for 5 years in a row. The median is 10% a year. So let's say we'll give them the credit that they'll be able to hit at least the median growth rate of earnings for 5 years in a row. Well, that's 10% a year. Calculate that out, that's a much lower stock price.
Right, they have to do a lot. They got a lot of work to do.
They've got a lot
We got to
of
leave
work
it there,
to do.
Mark Hulbert. Thank you very much.